What's up, my wise investors? This is Anusha and welcome back to the wiseelephant.finance. Today we are tackling a question that trips up so many people trying to get started with investing. What on earth is the difference between a mutual fund, an index fund, and an ETF, also called exchange traded fund? And crucially, which one should you be investing in to build your wealth without all the headaches? Because let's be real, the financial world loves its jargon, and these three terms get thrown around interchangeably, causing ton of confusion. But by the end of this video, you're going to have absolute clarity, know exactly what each one is, and walk away with a simple framework to pick the right one for your portfolio. If that sounds good, let's dive in. First things first, let's understand the umbrella term. What exactly is a fund in investing? Think of it like this. Instead of you going out and buying individual stocks, maybe some Apple, some Tesla, some Google, which can be expensive and time consuming, you and a bunch of other investors pool your money together. This big pot of money is then managed by a professional who uses it to buy a whole basket of different investments, stocks, bonds, whatever the fund's objective is. This gives you instant diversification even with a small amount of money. Okay, with that foundation, let's start with the granddaddy of them all. Number one, mutual funds. A mutual fund is a type of professionally managed investment fund that pools money from many investors to purchase securities. The key thing to understand about traditional mutual funds, especially when we compare them later, is that they're typically actively managed. This means there is a team of highly paid fund managers and analysts constantly researching, buying and selling stocks or bonds, trying to beat the market. Their goal isn't just to match the S&P 500, it's to outperform it. Sounds great in theory, right? You have got experts doing all the work for you. But here is the catch. That active management comes at a price. Mutual funds generally have higher expense ratios, which are the annual fees you pay to the fund company. We are talking anywhere from 0.5% to even 2% or more per year. And historically, most active managers actually fail to beat the market after all these fees. Another important point. You typically buy or sell shares of a mutual fund only once a day after the stock market closes at what's called the net asset value or NAV. So you can trade them throughout the day like a stock. Let's move on to number two, index funds. Now this is where things get really interesting, especially for us wise investors. Index funds. An index fund is actually a type of mutual fund. But instead of trying to beat the market, an index fund has a much simpler and arguably more effective goal: to track a specific market index. Think of an index like the S&P 500. The S&P 500 Standard & Poor's 500 is a stock market index that includes approximately 500 large cap companies from various sectors of the US economy. The index tracks the performance of 500 of the largest publicly traded companies in the United States and also represents roughly 80% of the total value of the US stock market. An S&P 500 index fund simply buys shares in those same 500 companies in the same proportions. It does not need a hotshot manager making daily decisions. It just follows the rule of the index. And because it's so passive, so mechanical, the costs are incredibly low. We are talking expense ratios of 0.03% or to 0.15% per year. That's just a fraction of what you would pay for an actively managed mutual fund. This makes a huge difference to your returns over decades. Lower fees means more of your money working for you. Like traditional mutual funds, you typically buy or sell index mutual funds once a day at the NAV. Number three, ETFs or exchange traded funds. Finally, let's talk about the incredibly popular and flexible ETFs or exchange traded funds. ETFs are very similar to index funds in their philosophy. Most ETFs are also passively managed and aim to track an index. In fact, many popular index funds also have an ETF equivalent. So what's the big difference between these two? The clue is in the name. Exchange traded. ETFs trade on stock exchanges just like individual stocks. This means you can buy and sell them throughout the day at their current market price, which constantly fluctuates. Whereas with mutual funds, you place your order and it executes at the end of the day. So this offers more flexibility, especially for day traders, but it's also great for long-term investors because it means you can usually buy just one share of an ETF, no minimum investment needed beyond the share price. Many mutual funds, on the other hand, might have minimums of $1,000 or a minimum of $3,000 to even get started. And a huge bonus for ETFs, They're generally more tax efficient than traditional mutual funds due to their unique structure. This means fewer taxable capital gains distributions each year, potentially saving you money at tax time. So it's a win-win. The Wise Elephant's recommendation. So you have got mutual funds, index funds and ETFs. Which one is right for you? Let's put them side by side with our Wise Elephant comparison table. The expense ratio is the annual fee you pay as a percentage of your assets to the fund company for managing the fund. It's automatically deducted from your fund's assets, so you don't receive a bill. It simply lowers your overall return. Actively managed mutual funds have higher expense ratios because you're also paying for a manager to try and beat the market. Historically, they rarely beat the market after these high fees are factored in. The index funds and ETFs often have the lowest fees of expense ratios because they just track an index which is cheap to run. This low cost is their very major advantage. So why all this difference matters? Now let's look at why that tiny percentage difference matters so much over a long investing career. This is going to shock you. Let's look at the simple example to understand the power of low fees. So imagine you start with a $100,000 portfolio and earn a solid 10% gross return every year for 30 years. Let's compare the typical fee of an index fund ETF 0.05% versus a typical active mutual fund 0.60%. Now let's compare two investors. Investor A, the Wise Elephant, chooses a low-cost ETF with a tiny 0.05% annual fee. After 30 years, they pay about $23,800 in fees. Their portfolio is worth nearly $1.8 million. Fantastic. Investor B, unfortunately, is in a high-cost active mutual fund with a common 0.6% annual fee. Over 30 years, they pay a staggering $231,600 in fees. Their portfolio is worth about $1.47 million. The difference between these two investors is over $309,000. This is literally hundreds of thousands of dollars that investor B paid to the fund manager instead of keeping it for their own retirement. And that's why the Wise Elephants obsess over fees. 0.55% does not sound like much, but when compounding is involved for a long period of time, it is the single biggest headwind you can face. Choose low cost, choose index or ETFs and keep the money working for you. And hence, for 99% of long-term investors, the choice comes down to index funds or ETFs. You want low-cost, diversified, passively managed investments. Why not an actively managed mutual funds? Because as we have seen, those higher fees almost always eat into your returns and very few managers consistently beat the market. So index funds versus ETFs, which one should you choose amongst these two? If your brokerage offers fractional shares of ETFs, meaning you can buy half a share or 0.1 share, or if you prefer the flexibility of trading throughout the day, ETFs are fantastic. If you're making regular automated contributions like $100 every 2 weeks from your paycheck, or if you just prefer the simplicity of mutual funds where you can invest exact dollar amounts easily, then index mutual funds are perfectly fine. Both of these will give you incredible diversification, low cost and powerful way to grow your wealth over the long term. So the key is to pick one and stick with it. While many popular funds are available everywhere as ETFs, Vanguard and Fidelity have specific mutual funds that are famous for their ultra low cost and accessibility within their own platforms. Here is a breakdown of the most popular broad market index funds and ETFs for each platform. I'm going to show you here a breakdown of the most popular broad market index funds and ETFs for each of these platforms. The following funds track the two most popular benchmarks, the S&P 500 index, the 500 largest US companies, and the total US stock market, nearly all US publicly traded companies. And my personal favorite, a technology sector benchmark. You can pause and take a look at it if you like to go over the ticker symbols. Fidelity's best index options are mutual funds, whereas the Vanguard's best options are often their ETFs. When choosing a fund, you're generally free to buy any ETF at any broker for free. But you should only buy a mutual fund that is native to your broker. For example, Vanguard funds at Vanguard and Fidelity funds at Fidelity, unless you're absolutely certain it's part of their no transaction fee network. Otherwise, you're throwing your money away. Also, most of the brokerages are now offering fractional investing, also called dollar-based investing. So you don't have to wait to have a large amount of money to get started. You can literally start with a single dollar. So there you have it, folks. The ultimate breakdown of mutual funds, index funds, and exchange traded funds. No more confusion. just clear, actionable knowledge to help you on your financial journey. If this video helped you untangle the fund jargon, please hit that like button and subscribe to the Wise Elephant Finance channel for more tips. And let me know in the comments below, which one are you investing in? Remember, investing should be simple and not stressful. Stay wise, stay patient, and I'll see you in the next one. Cheers.